but it has since fallen out of favor, and its latest results only sort of exemplify that. Now, its Q1 results missed by a mile, as we told you earlier. Here's what we have. EPS was 95 cents versus a forecast of $1.05. Revenue was a big miss as well, coming in at $961 million versus a forecast of $669 million. Now, analysts don't see it being rather consolidated results. This is in large part due to consolidated results from its money-losing online video business. And also, it paid more for traffic acquisition due to more competition from the likes of Qihoo 360, another Chinese internet company. Now, this is a critical cost for internet search firms. It's basically traffic acquisition is the payments made to affiliates and online firms to direct traffic website, also known as TAC. Now, here are all the reasons that Baidu is slumping. First of all, we have slowing earnings growth. 95 cents a share doesn't seem too bad. However, it has been slowing over the last few quarters, especially in 2012. Also, rising competition. I just mentioned Qihoo 360. It is quickly gaining on Baidu space. But remember, Baidu still has about 80% of the search market on PCs and desktops in China. Mobile, though, is a different story. And as we know, it is largely about mobile these days. And Baidu is having a hard time getting business and getting people onto its site in terms of its mobile application. In fact, it has about 35% of that market as of early 2012 versus that 80% market share that it has in PC and desktop. So, Martin, this is obviously, we talk about mobile all the time here. It is the future of tech. So if Baidu can't get that up, then that leads investors to say that they may not turn this around anytime soon.
Then what? A lot of uncertainties over this migration to mobile. Okay, do you walk on back here? Keep talking and bring in Qihoo He, Senior Vice President, also Senior Analyst at Maxim Group, joining us live out of New York, and still with us around the desk here at the SGX, our guest host, Steve Bryce, Standard Chartered. Echo, you don't like Baidu at all. You've got a sell on it, and you're looking at $75 for a price target. Specifically, talk to us about your concerns.
Baidu is probably one of the top Chinese internet companies. It's actually, although I have a sell rating, I think it is still a good company. The problem mostly just like previously, just a minute ago we just said, competition is one thing. Baidu is also trying to develop mobile search very hard. But most likely the problem is itself. Historically, Baidu has been very good. It raked in a lot of revenue, grabbed 80% or more than 80% of Chinese search market, and had more than 70%, actually 78% at the peak of gross margin. That kind of historical financial record is really hard to repeat in the future and evolving internet search market. That's actually the problem, in addition to actually the weakening economy in China.
Right. Echo, so Baidu, though, still very much the leader in China in terms of its search engine. Do you think this threat from the likes of Qihoo 360 or maybe any other names that you know of present a real threat to Baidu, or is it going to continue to have these decent results but maybe not so much growth?
Baidu, in terms of actually revenue, what we look at is last year's results. Baidu had probably 80% of the market, but in fact, the traffic share actually is following behind. It's right now, depending on what kind of source you're talking about, is probably around 70%. That's actually trailing its revenue share. That's because the market has not factored in Qihoo's revenue yet. But with that traffic share trading behind its revenue share, that's not a good sign for the future growth. And Qihoo, although it's small, but it's coming on strong. It's really coming on, competing Baidu on the aggressiveness of marketing and also cutting price on search. So that gives Baidu a lot of threat. It gives us concern that whether Baidu can hold up at this level. My actually forecasting is actually weakening revenue growth and weakening margins throughout the year and maybe beyond.
Yeah. Okay, Echo, Steve Bryce wants to jump in.
Hi, Echo. I see that they're spending a lot in terms of research and development. So you're looking at 80% growth over the course of the last quarter. Is that something that's a defensive move to try and protect market share, or is it something that's trying to, take them to a new level in mobile or wherever to accelerate earnings growth going forward?
Baidu is doing both from both sides, protecting its market share and also trying to find new growth drivers. That new growth drivers, one is we talked about mobile search, and the other is Baidu is probably trying to penetrate more deeper in the market in China search. And Baidu actually has started acquiring smaller companies, a newer business model in the China internet market. So today we heard that a local report said it's probably going to acquire a local video operator, that's PPS. This is after Baidu already established iQIYI of its own online video operator. Right. These actually acquisitions may boost Baidu's future growth. That's what we talk about future growth is long term, but near term, this year or maybe next year, Baidu is hard to re-accelerate growth at this point.
Right. Now, Echo, Baidu used to be sort of the darling, as I said, of American investors who wanted some exposure to Chinese tech. It has fallen about 10% this year, but if not Baidu, where should American investors or any investors get their exposure to Chinese tech in the ADR market? I mean, we have names like Sina and Qihoo 360, which I know you say is a buy, but its trailing PE ratio is, 88, and Sina is over 100. So where do you go? What should you be buying? Is there more room for some of these shares like Sina and Qihoo to increase further?
And just a little bit of correction, I have a buy on Qihoo, but I still have sell on Sina. Sina's problem is a new growth driver may not be as good as people expected. That's another story. Let's come back to Baidu. Baidu actually right now is on the trend of deaccelerate of revenue growth and a margin declining trend. But in terms of valuation on the PE level, that's the price per earning level, it's relatively cheaper. Just as I said, although Baidu is on the declining trend, it's probably still one of the best China's internet companies.
But what about Qihoo 360? That's what I want to know about, because you have a buy and its PE is just enormous.
Right. PE, in terms of what? Comparison-wise, Qihoo is probably more expensive than Baidu right now, just because Qihoo's growth potential is definitely better than Baidu. It has a reason to justify it. But compared to some other internet companies, for example, like Sina or Youku, those are the other two companies I cover. I also have sell rating on them. Qihoo is relatively cheaper. So I think with the Qihoo's ramping up search revenue from a very low base, and the search growth is probably going to support current valuation. And for my current model, I think it may be some upside. I can adjust Qihoo's estimated numbers.
All right, listen, Echo, we got to go. Great to talk to you. Thanks for the value add. Echo He there from the Maxim Group. And we've got more ahead with Steve Bryce from Stanchart, our guest host. To get a question in for him by emailing us at squawk@cnbcasia.com. All right, we're going to take a quick break. Before that, though, we wanted to show you some of these pictures. Take a look.